Devang, what's pulling the markets down?
Good morning. Thanks for having me on the show. I think actually no reasons to complain. In fact, the rally that we had, the nature of the rally was extremely fast and furious. I think since March end, we never had a meaningful correction, and it was just a one way up. The trend was one way up. I think it was supported by a lot of fundamentals, a lot of macros, a lot of micros. Sentiment improved towards equity. There was sort of global turbulence that sort of also hadn't seen a heightened sort of a volatility across the globe as well. So I think all the factors, the confluence of factors led to this spectacular rally. And I think probably somewhere down the line, there has to be some gravity. And that's what we are right now seeing. It's not sort of a meaningful correction as yet. It's sort of a correction or consolidation, if you put it that way. There'll always be ebbs and corrections on the way the earnings season sort of is on. And I think we are getting towards the fag end of it. Also a bit of macros in terms of the crude prices rising, in terms of also dollar index rising. There are a couple of this headwinds which have just come to the fore. So my sense is that yes, this is a correction which one has to take with both hands, with an open mind. And again, there'll be a lot of opportunities on the way. I think all the foreign strategist boardrooms have discussions about India. Nobody sort of can ignore India as it's sort of in the dark clouds, it's sort of a silver lining, as I always say. And also, if you look at the FDI investments over a period, India is sort of qualifying as an investment destination, be it China plus one, be it Europe plus one, anything. I think probably yes, this is the correction. One needs to take it with an open heart, and sort of there can be some more on the table. But as I said, no reasons to complain. One needs to just stay focused on the fundamentals of India and sort of build portfolio that way.
Hi Devang, good morning. Nice to have you on the show. Help us understand this, this outflow on account of FIIs, even though direct equity investors, DIIs are more than making up for the losses. But why do we see this flight of capital when it comes to FIIs right now?
Extremely good question. I think what we have seen over the period is that FIIs and DIIs, it rarely happens in Indian equities, both of them, a confluence of flows from both of them we saw in the recent past. The last 2-3 months, I think we have seen flows increasingly from FIIs, which to the better part of the last year were sort of absent. And it was only the domestic investor strength, the strength of retail investors, HNIs, family offices, ultra HNIs, mutual funds, PMSs, equities, direct equities, all this came to the market. I think it was ably supported by FIIs who sort of were in fact left out during the first part of the rally. The sense one gets here is yes, as equities reach towards a certain valuation zone, maybe right now India trades at around say 19.5 times 1 year forward. If you put a EPS of say 1050, 1100 for next year FY25. Yes, somewhere down the line, are we expensive? Slightly, yes. Probably we are not as expensive. We are fairly valued. There will be a lot of bottom-up opportunities. FIIs might probably book out for some time. The last 7-8 days we have seen sort of they're booking certain profits and they're getting out into equities, but it's not been as meaningful as it probably would. So my sense is FIIs will not ignore Indian markets for a longer duration. It may be a short-term phenomenon where markets would have rallied ahead of time, and there will be some profit booking on the table.
Okay, and what about these talks in the US right now of potential multiple rate hikes? What is that going to do to, let's say, investors, foreign institutional investors? How would they be reacting to more rate hikes in the US?
Yes, again, it's quite data dependent. We have seen just one rate hike a week back, and again, the commentary over there is more or less. They say that will be more data dependent. The inflation has definitely come down, but it's a sweet problem to have in a way. If you look at the consumer confidence index, if you look at the jobs data, I think US economy and a lot of parts of US economy are still doing extremely well. So I think the recession call a lot of people had is probably tapering down towards a slowdown type of a call. So if the recession doesn't happen, I think it augurs very well for Indian exporters as well. Yes, FIIs have their sight on developed markets, emerging markets. They have a lot of as such choices to make in terms of where they allocate their money. And India, I think, primarily rates among the top quadrant, maybe in the first couple of markets. So I don't think there'll be a long pause in sort of putting money into India or allocating more money to Indian equities. So I think that seems to be ruled out. Yes, there'll be periods of hibernation, a couple of months, a quarter or 2 quarters, and then probably again the flows can start resuming back.
Okay, and as far as the domestic India story is concerned, the RBI MPC is underway right now, and from what it seems, it is likely to be another pause, though we're going to get the fine print of that only tomorrow once the MPC comes out with its decision. But I think the market seem to be prepared for a pause. What happens if we actually see another rate cut, or another rate hike in India?
I think probably you are right. Status quo seems to be the consensus call at this point, and I think inflation has sort of trend downwards in India as well. And RBI would also want to wait what the Fed does over there. The call seems to be more or less, as you said, status quo. It's more the commentary, whether it's hawkish, whether it's dovish, whether it's neutral. That's where the market participants would have their sights set. And I think probably we have seen sort of the worst of rate hikes in India, at least. And market is probably factoring in that we would probably see rate cuts in the next year, in the next calendar year, if not in the financial year at least. That is where most of the corporates have utilized their balance sheet. Most of the banks have sort of has healthy balance sheets to fuel the next round of growth. So I think this augurs very well if we somewhere pause in the rate hikes, which already RBI has done. And I think it's been extremely pragmatic in terms of its monetary policy management. That's one thing which I can say.
Okay, talk to us, sir, about mutual fund inflows at a 4-year high in this quarter. Data that came out suggested 1.85 lakh crore rupees invested by way of mutual funds. I'm assuming most of those would be retail investors. What is the mood for retail investors? What are they really seeking? Are they seeking alpha at this point, or is the tilt towards index funds, because index funds are also likely to deliver, passive investing is also likely to deliver better than average result?
A very good question. I think it's a combination of both. There is a population who sort of seek alpha. They go towards more or less active mutual funds or PMSs or direct equities and stuff. Yes, there is also a class of investors which have started surely, but slowly started to come up in India as well, right? You know that US is more or less dominantly being seen as a market where a lot of people invest in ETFs. The majority of the people at least do that. In India, yes, numbers do suggest that we have a plethora of money coming towards even passive investments or ETFs as such, or index funds. As a lot of this population also believes, at least to get the market rate of return, it's very important not to get succumbed to FDs where you probably can't even beat inflation. So the answer is either go towards the ETFs or the index funds where you will get the market rate of return, or if you are seeking alpha, I think India is still a market where you can do a lot of bottom-up stock picking, be it large cap, be it mid cap, be it small cap space according to the risk appetite. So sense one gets here is that it's a combination of both. Retail investors have sort of matured over the period. They do a lot of SIPs, which is systematic investment plan in equity mutual funds. This over the last 6-7 years since demonetization, this number has been just creeping up. So that's a blessing in disguise, that any outflow that FIIs probably create in India, there is always a domestic cushion and the support which gets provided.
Got it. Talk to us specifically about sectors, sir. Sectors which, despite us all living in a very interconnected world and globalization, talk to us about sectors that are more likely to be resistant to whatever is happening in the world around us. IT sector, we have seen over the last quarter, IT results coming out, not really delivering great returns. In fact, not even meeting street expectations. Talk to us about which are the sectors that you think are going to be a little more resistant, insulated from what is happening in the world around us, whether it is the Russia-Ukraine war, whether it is rate hikes in the US or China's ghost factories.
I think that's where the bulk of the things will happen. I think domestic-centric plays is one which will not have much of an impact if there is something wrong which goes across the world. And I'm no way saying that we are sort of decoupled, right? We are coupled for our energy needs as well. So anything that happens in the Western world or the developed markets or other emerging markets, we probably will have a bit of impact on us as well. But we would relatively sort of outperform. And in that sense, the sectors of the themes which look extremely interesting are something which I call a financialization, right? Or a credit growth as a theme. Financial financialization is India has seen people moving from savings towards investment. India has seen people moving from physical assets to financial assets. In that terms, a lot of your banks, a lot of your NBFCs, insurance companies, all this as a theme would do extremely well. So one theme which you can't miss, and it's a proxy play for the India economic growth, is something called financialization. The second theme which comes to mind is something called capital expenditure or capex growth. We have seen government doing a lot of capital expenditure over the last 8-9 years. The infrastructure has sort of seen visible changes in India, be it roadways, railways, metro, mono, highways, airways, ports. I think a lot of this infrastructure has got created in India as well. So this is something which public infra has been created. Private capex has also started to come back to the fore, which is also very important, right? So I always tell this, that railways used to have a capex of around 50,000 crore 3 years back. Right now, the capex is somewhere in excess of 2 lakh crores. So that is where I think a lot of capital expenditure is also done by corporates in brownfield and greenfield projects. So this theme, as such, capital goods, cement, infrastructure, building materials, this theme will also sort of do well. And consumption has been India's strength. So sort of discretionary consumption, premiumization in terms of your auto and auto components, this sector also looks quite interesting.
Okay. And so talk to us also about the fact, since you mentioned infrastructure, we are also in an election year, and for the GDP to be kept intact and for the GDP to only grow, I think the heavy lifting will continue to be done by the government, while the private sector still holds on to cash to see what sort of a policy framework emerges whenever the new government is formed or the existing government gets a new term. So from a retail investor perspective, what should be the strategy right now? Buy the index, buy blue chip stocks on dips, or just continue with your mutual fund SIP routes? What is the best investor strategy that you can offer right now for retail investors, knowing very well that we are heading into election year and volatility cannot really be ruled out?
So, Karthik, a very good question again. But as I always say, that volatility has to be the friend of the long-term investor rather than an enemy. So, the sense one gets here is volatility will be the order of the day as we move ahead, because globally also, as I said, we are aligned, and there are a lot of factors which drive markets, be it sentiment, be it liquidity, and of course the earnings rule supreme. So, we feel that the earnings from here on for the next 3 years, we could at least have a conservative earnings growth for Nifty from, let's say, 13 to 15%, and there will be incrementally good earnings growth in good mid-size and good small cap companies. No way saying that everybody needs to get into that segment, but yes, one can also plan that one can invest in tranches. Probably in the next 3 months, 6 months, one can have a strategy where they can start investing in sort of SIPs as they regularly do that. They should also probably plan out and go back to the drawing board, look at the portfolio construction. If they already have a portfolio, get out of gruesome stocks. I think we have seen a lot of companies right now running ahead of fundamentals. The valuations have reached levels which are not sustainable. Somewhere these companies are not, somewhere some companies are not great in terms of the robustness of the business model. One should get out of that. One should probably buy companies where there is a very high degree of corporate governance, a very good corporate governance, ROE, ROC about 15-18%, revenue, PAT and EBITDA growth at a certain percentage. The size of the opportunity has to be large. These are companies have to be high market share companies, and there has to be something called margin of safety, which gives you good night's sleep and stress adjusted returns. So if one can find this type of businesses in the direct equity space as well, buy or accumulate this type of businesses over the next 3-4 months, and then probably one needs to give time for this types of businesses to sort of materialize over the next 2-3 years.
All right, Devang, before we let you go, also, as we briefly touched upon, RBI MPC is meeting today. We are likely to see some sort of, commentary coming in from the MPC by tomorrow. What are your expectations like?
I think probably the rate call can be more of a status quo. The commentary which the participants want to hear, be it market participants, be it the economists, is how probably inflation will trend downwards, and what is the trajectory of the interest rates going forward. What are the growth parameters that the RBI is considering, whether it's pro growth, it's sort of pro, I can say, or an anti-inflation strategy, or a combination of both. That is what is more or less desired from the commentary and the body language of the governor whenever he speaks tomorrow.
All right, Devang, appreciate you joining us this morning and for sharing your wealth of ideas, inputs here on News9. We'll get you back very, very soon. Thanks very much.